How many ounces of silver are you holding right now? Not how many you plan to buy, not how many you think you'll get next year. Right now. Because the real question isn't price, it's positioning. While retail investors are all in on equities at near record leverage levels, something very different is happening under the surface. Margin debt is elevated, options exposure is near extremes. Liquidity is concentrated in a handful of mega cap stocks tracking the S&P 500. But smart money doesn't usually crowd the obvious trade. Quietly, physical metal continues moving into stronger hands. Delivery data from CME Group has shown unusual physical settlement levels compared to historical norms. For decades, less than 1% of contracts stood for delivery. Now, that number has structurally shifted. That matters, because silver is not just another commodity. According to the Silver Institute, the market has experienced multiple consecutive years of supply deficits. Demand from solar panels, EV infrastructure, AI data centers, military electronics, and green energy continues accelerating. Silver isn't just money, it's technology. And here's the uncomfortable math. Only about 20 to 25% of global silver production comes from primary silver miners. The rest is a byproduct of mining other metals. That means you can't just turn on more supply because the price spikes. Discovery to production takes years. Permitting takes years. Infrastructure takes years. But demand turns on overnight. Now zoom out. Central banks around the world have been accumulating gold at the fastest pace in decades. According to the when sovereign entities move toward hard assets, it's usually not random. And when liquidity engineering increases in the short-term treasury market via policy tools from the U.S. Department of the Treasury, it tells you something about how fragile the system might be underneath the surface. Markets today are heavily financialized, paper claims dominate, but silver is one of the few assets where physical delivery can expose stress. Historically, the gold-to-silver ratio has averaged around 45.1 in the modern industrial era. In 2020, it spiked to 125.1, an extreme divergence. The long-term geological ratio was closer to 16.1. When ratios stretch too far, they don't stay stretched forever. So I'll ask again, how many ounces are you holding? Not dollars, not brokerage statements, ounces. Because here's the psychological trap most people fall into. They wait for confirmation, they wait for headlines, they wait for price to explode. But by the time silver's front page news, premiums are gone, supply tightens, and availability changes. During past demand surges, retail products like American Silver Eagle traded at massive premiums over spot. Constitutional junk, silver disappeared. Inventory dried up. And that was without global sovereign competition for physical delivery. Right now, retail participation is still relatively muted compared to equities and crypto. Bitcoin absorbed much of the hard asset narrative over the past cycle, but Bitcoin is digital scarcity. Silver is physical scarcity. Different game. If institutions continue accumulating and the sovereign entities stand for delivery instead of rolling contracts, paper leverage becomes harder to maintain. And when paper leverage compresses, volatility expands. The question isn't whether silver will move, it's who will already be positioned when it does. Some people think in dollar terms, smart people think in ounces. Because if currency purchasing power shifts, the number of dollars per ounce becomes less relevant than the number of ounces you control. This isn't about panic. It's about preparation. It's about understanding cycles. Every cycle has a moment when complacency flips into urgency, when retail finally notices, when headlines shift from boring metal to shortage, when people ask, why didn't I buy when it was ignored? So ask yourself honestly, if silver doubled tomorrow, would you feel secure? If silver tripled during a liquidity event, would you be satisfied with your positioning? Or would you wish you had accumulated more while nobody cared? Because historically, the biggest moves happen when public interest is lowest. Right now, public interest is still low. That window doesn't stay open forever. So I'll leave you with this. How many ounces are enough before it's too late? And more importantly, are you counting dollars or are you counting metal? Let's go deeper, because most people underestimate what too late actually means. Too late doesn't mean silver is $200. Too late means supply tightens, premiums explode, and availability disappears before price even reflects reality. We've seen this before. During past liquidity shocks, dealers ran out of inventory. Premiums detached from spot. The paper price said one thing, the real world price said another. That disconnect is where stress shows up first. And right now, the paper to physical ratio still favors the paper market. But that only works as long as trust holds. For decades, almost nobody stood for delivery on futures exchanges. Contracts were rolled, settled in cash, closed out before expiration. But when delivery increases, something shifts, because delivery forces the system to perform, and performance exposes leverage. When more participants demand physical settlement instead of paper rollover, it compresses available float. Now think about this carefully. Global silver demand isn't coming from one place. It's coming from solar expansion, AI server farms, EV production, military tech, electronics, medical applications. Every advanced economy is pushing electrification and digital infrastructure. Silver sits at the heart of conductivity. You can substitute many materials in industry, but you can't easily substitute silver's conductivity efficiency. And here's the part most investors ignore. Even if silver prices spike tomorrow, it doesn't instantly create supply. Mining supply responds slowly. Industrial demand responds immediately. That imbalance is structural. Now layer on top of that the monetary angle. When inflation cycles reemerge, confidence in fiat systems tends to weaken at the margins. That doesn't mean collapse. It means gradual erosion. In those environments, hard assets quietly reprice. Historically, metals move in phases. Phase 1, smart money accumulates quietly. Phase 2, price starts trending. Phase 3, media attention increases. Phase 4, retail rushes in. Phase 5, blow-off volatility. Ask yourself honestly, which phase do we look like we're in right now? Retail enthusiasm is still concentrated in tech stocks and leveraged trades. Hard assets are not the mainstream conversation yet. That tells you something. Now let's talk psychology. Most people anchor to price. If silver hits $40, I'll buy. If it drops to $18, I'll buy. But serious accumulators don't think like that. They think in allocation. They ask, what percentage of my net worth is outside the financial system? What percentage is in assets with no counterparty risk? Silver has no earnings report, no CEO, no bankruptcy filing, no dilution. It either exists in your possession or it doesn't. And in a world increasingly dependent on leverage, derivatives, and engineered liquidity, simplicity becomes powerful. That's why the ounce question matters more than the dollar question. Because if currency purchasing power fluctuates, if debt markets experience stress, if volatility expands, your ounce count stays constant, dollars don't. Now here's another uncomfortable truth. When momentum finally hits silver, it tends to move violently. It doesn't grind slowly like bonds. It doesn't stair-step like blue-chip stocks. It gaps, it squeezes, it reprices fast. That volatility scares weak hands out and rewards prepared hands. Which brings us back to the core question. How many ounces are you holding before it's too late? Not what you wish you had. Not what you almost bought. What you actually control. Because once public participation increases, behavior changes. Dealers widen spreads, premiums adjust, inventory tightens, delivery times extend. That's when people realize price wasn't the real risk. Delay was. And here's something most never consider. Silver doesn't need the entire public to move. It's a relatively small market compared to global equities or bonds. Even a modest capital rotation can create outsized price reactions. That asymmetry is what makes it interesting. Limited supply, growing demand, low public participation, institutional positioning, shifting, geopolitical undercurrents, high financial leverage elsewhere. You don't need panic, you don't need collapse, you just need imbalance. And imbalance already exists. So the real strategy isn't timing the perfect bottom. It's avoiding the regret of underpositioning. Because once narrative flips, it flips fast. And when it does, the question won't be, should I buy? It will be, why didn't I accumulate when nobody was paying attention? So again, how many ounces are enough for you? And are you confident in that number if the cycle accelerates sooner than expected? Because markets reward preparation, not reaction. Let's take this one step further. Because the real shift doesn't happen when price rises. It happens when perception changes. Right now, silver is still perceived as optional, a trade, a speculation, a maybe later asset. But perception can flip faster than supply can respond. And when perception flips in a thin market, volatility expands dramatically. Silver's total market size is tiny compared to global equities, bonds, or even large cap tech stocks. A relatively small reallocation of capital can create disproportionate moves. That's not hype, that's math. Now think about the global environment. Debt levels are historically elevated across major economies. Governments continue rolling short-term obligations. Liquidity tools evolve. Financial engineering increases. When systems become more complex, fragility increases alongside them, And in fragile systems, simplicity gains value. Physical silver is simple. No algorithm, no counterparty, no credit risk, no quarterly guidance. It just is. That simplicity becomes attractive when trust in layered financial products starts eroding at the margins. And here's something most retail investors miss. The public typically moves last. Institutions move early because they analyze flows, balance sheets, settlement stress, and structural imbalances long before headlines form. Retail moves when price confirms. By the time retail arrives in size, early accumulation is already done. Ask yourself this. If sovereign entities decide to diversify marginal reserves into physical assets, if industrial demand keeps compounding through electrification, if supply remains constrained because primary silver mining is limited, what happens when those forces converge? You don't need a shortage headline, you just need tightening. Tightening changes behavior. Dealers adjust premiums, wholesalers restrict large orders, delivery times stretch, spreads widen. That's the early signal, and that's when people start scrambling. But scrambling is expensive. Preparation is calm. Let's also address something psychological. Many investors underestimate silver because of past volatility. They remember sharp pullbacks. They remember false breakouts. They remember years of sideways action. But cycles don't repeat identically. They evolve. What was once a purely monetary metal is now deeply industrial. What was once retail-driven is now increasingly influenced by institutional positioning and global settlement dynamics. That shift matters because it changes the character of future moves. Another important factor is leverage concentration in other markets. When capital is heavily allocated to equities, derivatives, and speculative growth sectors, systemic shifts tend to force rotation. Rotation doesn't ask permission. It happens quickly when volatility spikes. And when rotation seeks safety or tangible exposure, hard assets become logical destinations. Silver benefits from both monetary and industrial narratives. Few assets have that dual role. That duality is powerful in uncertain environments. Now let's talk allocation logic. Serious investors don't ask, will silver hit X price? They ask, if financial conditions tighten unexpectedly, what assets maintain purchasing power? Silver has historically performed during periods of currency stress, inflation acceleration, and monetary uncertainty. Not perfectly, not smoothly, but decisively when momentum builds. And momentum in silver is rarely slow. It compresses years of inactivity into months of acceleration. That's what catches people off guard. They assume they'll have time. Markets don't always give time, especially in assets where available float is smaller than perceived. The paper market gives the illusion of abundance. The physical market reveals reality. When physical demand pressures exceed paper confidence, repricing can happen abruptly. So the ounce question becomes strategic, not speculative. If volatility returns to broader markets, if liquidity tightens, if geopolitical tensions escalate, if inflation proves stickier than expected, do you feel positioned or do you feel exposed? Because too late doesn't announce itself. It creeps in through rising premiums, through tightening spreads, through delayed fulfillment, through subtle shifts in dealer inventory. Then suddenly it's visible. And visible usually means expensive. The goal isn't fear, it's foresight. There's a difference. Fear reacts. Foresight prepares quietly. Silver accumulation isn't about betting on disaster, it's about hedging against imbalance. An imbalance is already present in multiple layers of the global system. High debt, high leverage, high asset concentration, constrained supply chains, growing industrial demand. When multiple pressures align, the probability of volatility increases, and volatility rewards those who already hold position. So, once again, the question matters. How many ounces are enough for your situation? Not someone else's, yours. Because when the cycle accelerates, confidence doesn't come from price predictions. It comes from knowing you're already positioned. And in markets, peace of mind is often more valuable than perfect timing. And here's something most people won't admit to themselves. They don't hesitate because they lack information. They hesitate because they're comfortable. Comfort is the most expensive position in investing. When markets feel stable, when equities are near highs, when volatility is low, when headlines feel controlled, that's when preparation feels unnecessary. But cycles don't turn when everyone is ready. They turn when most people are distracted. Right now, attention is elsewhere. AI stocks, crypto rallies, short-term trades, option speculation. Silver is not dominating headlines. And historically, that's when it has offered the best asymmetric positioning. Because silver doesn't need mainstream attention to move, it needs imbalance. And imbalance builds quietly. Let's zoom out one final time. Global electrification is accelerating. Industrial demand remains structurally strong. Supply growth is constrained. Financial leverage across broader markets is elevated. Institutional behavior is shifting toward tangible assets. That's not a prediction. That's an observation. Now ask yourself something simple. If 5 years from now silver is significantly higher, will you look back at today and say, I should have accumulated more when it was overlooked? Or will you feel satisfied with the ounces you secured while sentiment was neutral? Because regret in investing rarely comes from taking measured preparation. It comes from ignoring slow-building signals. And silver is one of those assets that moves from boring to urgent very quickly. There's usually no long transition phase. It flips. Suddenly premiums widen. Suddenly dealers update pricing daily. Suddenly delivery stories trend. Suddenly retail interest spikes. And once that happens, accumulation becomes emotional instead of strategic. You never want to buy from emotion. You want to buy from clarity. The ounce question is really about clarity. How many ounces would make you feel insulated from monetary instability? How many ounces would make you comfortable during a liquidity shock? How many ounces would make you confident if volatility spreads across equities? There isn't one universal number, but there is a personal number. And if you haven't defined it yet, that's the real risk. Because markets reward defined strategy. They punish indecision. Silver doesn't promise certainty. It offers optionality. Optionality during uncertainty is powerful. And in a world increasingly dependent on leverage, policy engineering, and digital abstractions, physical assets represent independence, independence from counterparties, independence from margin calls, independence from system complexity. That independence has value long before crisis. It has value during calm. Because calm is when positioning is cheapest. So before you close this video, pause for a moment. Think in ounces, not in price targets, not in hype, not in fear, just ounces. Are you underpositioned, overexposed elsewhere, balanced? Only you can answer that honestly. But one thing history shows consistently, the biggest moves happen when participation is lowest. And right now, participation is still concentrated elsewhere. That window doesn't stay open forever. So if you found this breakdown valuable, if it challenged the way you think about allocation, if it made you reconsider your positioning, hit the like button so more investors can see this analysis. Subscribe for deeper macro and precious metals insights every week. And in the comments, tell me this. Are you counting dollars or are you counting ounces? Because the difference between the two could define the next cycle. I'll see you in the next video.